Welcome to In Great Company. My name is Ramona Cedeno, and I'm your host. In Great Company is a platform where we bring you thought leaders in business to share their expertise, advice, and experiences so that you can thrive in your business. Today, I am joined by Sumeet Shah, and he is in the partnership, in the VP in the partnership team at Clearco, and he's going to talk to us about funding, VC funding, the how to, the where, and how to really use those funds in a way that's effective for your business. Welcome, Sumeet.
Thank you so much, Ramona. Pleasure to be here, and thank you so much for the wonderful introduction. We're excited to showcase. I say we, as in myself and my new team, also in the New York office of Clearco. We're excited to showcase more about our work, especially providing efficient capital through working capital investment to e-commerce companies. And to date, since our founding in 2015, we've provided over $3 billion worth of capital to over 6,500 founders. On top of that, I have the absolute pleasure of being a two-time VC, helping to start two different venture capital firms in the consumer world.
That's awesome experience, and this is going to be very helpful to our team, but to our audience. But I know that you have done a lot more, and prior. So tell us a little bit about your career and how you're helping small businesses and tech companies to really get those fundings that they need to be successful.
Thank you. And absolutely, Ramona. So I graduated college back in 2008, which was quite an interesting time to be graduating college due to, of course, the financial crisis. I ended up in a consulting firm focusing in the private equity industry. So working with a lot of more later stage businesses, helping them to grow and scale. And obviously coming out in 2008 and building with those companies, there was a lot of trying to fix sinking ships, to say the least. But fortunately, coming out of the ashes of the financial crisis was the launches of some of the incredible consumer startups and companies that we know today. Companies like Uber, Lyft, Warby Parker, Birchbox, Harry's, Peloton, AppNexus, Oscar Health, so on and so forth. It was really the first wave of consumer investing that we now are seeing today. The second wave really came around in the 2010s, in the late 2010s, where you saw the rise of companies like Away, Glossier, etc. So with all that, I started meeting a bunch of people in the venture capital world and in early stage consumer world during my work over at that consulting firm when I was doing business development for them later in my years there. I transitioned to the startup world in 2013 and reconnected with one of those investors who was an angel investor in the beauty space at the time, as well as his colleague who was running a firm that was an agency slash venture capital firm hybrid called Consigliere Brand Capital, is now known as Bullish. That man named Mike Duda, and the previous person I mentioned was named Andrew Mitchell. Andrew brought me on as he was starting a brand new venture capital firm in early 2014. That firm would become Brand Foundry Ventures, and I was there for 3.5 years, helping to source and send over through deal flow. Worked on about 20 deals in my time there. Companies you might know, companies like Cotopaxi, The Wing, Rockets of Awesome, Allbirds, Lola, so on and so forth, if you're familiar, of course, with the consumer world. But again, early stage consumer that we also led deals for as well. I stepped away from that company in 2017, spent about 1.5 years doing freelance work, doing business development partnerships and strategy for various founders and startups, for various brands and various agencies. During that time also in late 2018, I spent time actually just working through various nonprofits and things, and at a gala met a man named Sid Jawahar, who was running a global investment fund in the consumer world called SwiftArc Capital. Over the next conversations we had outside of the gala, I learned that he was actually looking to raise an early stage venture arm of SwiftArc. I was helping him build out a lot of that infrastructure, helping him and his partners. And in early 2019, after finishing another contract, he reached out to me, flew me out to Santa Barbara to meet with the rest of the team, and offered me an opportunity to help start SwiftArc Ventures from the ground up. I was there for about 2.5 years. I built out our investments team, then our fundraising team, then our platform team, and then operations. We have team members now running all the first three, and I was running basically the infrastructure and the future of the firm within operations, really just the plumber, if you may. During that time, was working and building up the firm and its early stage consumer and healthcare, We're operating out of 4 funds: an early fund called Labs, a beauty fund, a telehealth fund, and then a growth fund. During my time there too, I was actually working with an organization now known as Clearco, formerly known as ClearBank, which provides revenue-based financing to e-commerce startups through non-dilutive working capital. Now, what does that mean? That means that they will provide capital that's not equity related. So no equity is taken. It is focused towards working capital investment, which is either for inventory or for marketing and ad spend primarily. And Clearco takes its capital back or earns its capital back through a rev share agreement. So basically a percentage of daily sales that they will get their capital back plus the fee. The fee is usually between 4 to 6%. Now, I had worked with Clearco in the past. I'd sent companies their way. And last year, I was actually on a panel with the co-founder and CEO, Michelle Romano, which was quite exciting on that time. And late last year, I was approached by the Clearco team as they were looking to build their US presence and primarily with New York. So after a few very quick interviews, they brought me on and basically made me an offer I couldn't refuse. I transitioned to an advisory role over at SwiftArc, and I'm now running the New York arm of Clearco on its partnerships team. So it's quite exciting. We're actually putting together our first event this Thursday in New York. If anyone here is listening in and is interested in attending, feel free to follow up with me. It's just sumeet.shah@clear.co. But let me know as well that you found it from the Firebreak in good company conversation. But yeah, that's really just a great background going from the later stage to the early stage and really getting a nice mixtures between the investing world on all levels: private equity, on venture capital / angels, as well as now in the world of alternative financing.
Yes, we have spoken a few times, and every time we speak, I'm just amazed at how much you have done in this space and what you're doing now. So it's so happy, it's so good to have you here. And I'm very familiar with the Clear Co model, and I think it's such a great alternative for financing, especially because it's non-dilutive. And we'll talk a little more about that as we go through the different types of options for funding. So tell us a little bit about that. Like, in addition to this model that Clearco offers, what are the other funding options that are available for startups today?
Yeah, so I would really break it down into 3 kind of areas. There's institutional capital, which is equity capital. There's debt capital, which is then broken down into different areas. And there's ways of alternative financing. When you think about equity capital and institutional capital, it's primarily focusing towards angel investors, venture capital firms, and private equity firms. Angel investors are pretty straightforward. They're angels. They're individual investors who are investing, simply put, with their own money. They're looking to take equity in the companies. Angel investors themselves will also be happy to take capital through debt instruments, also known as convertible notes, only just because it's much quicker for them to go through. It's basically a debt note that does convert to equity down the line. I just want to mention that before we get into the debt side of things as well, because that is quite popular with angel investors and some venture capital firms. Venture capital firms are the early stage institutional shops. They invest with other people's money, known as limited partners or LPs. And they are basically the first firms in the game. They invest in seed or even pre-seed all the way up to pre-IPO. There are different various sizes of them, more prominent ones versus others. But the great thing is there are more and more venture capital firms that are being run by just seasoned operators from the industries. Then you have private equity firms, which are much larger institutional investments. Same concept with venture capital firms in terms of where the money's coming from, how they make money, both in terms of management fees and carried interest. So that's something that we can talk about later, but don't want to touch too heavily because it's not pertinent to founders here. But they are just more focusing towards close to profitable or profitable businesses. They are looking to take basically majority stakes into company, where venture capital firms will take sizable stakes, but not majority. That's the first block when you think about with equity capital. And the pros are that you have much larger shops, you have opportunities for larger growth. But of course, there's the issue of dilution, where you might get some great capital, but you also have to recognize how much percentage of the company you're willing to give onto that end. Because I've seen great companies that have grown successfully and gone public, but the founder maybe has ended up with just a couple percentage points of the company. So it's not really a great ending for him or her. versus ones that have maybe only raised little to no funding and then have sold for significant portion, and they've already kept a significant amount of equity. So they have done quite well in the end. Um, so that's equity. Debt, where you have all different kinds of locations for venture debt. You have the banks that also can provide lines of credit. You have other organizations that will give you those loans. Again, angel investors that can have help from that as well. And it's great because it's usually much quicker to raise capital from there. With institutional capital, can range between as little as 4 to potentially as high as 8 weeks plus to go through due diligence and partner meetings and all the transactions with the term sheet. The simplest way that a law firm told me is that the number of pages in a term sheet for a venture can usually be 15 plus. The number of pages for debt can be 4 or less. So just a simple way in terms of for the legalese side of things. But
I like that. That sounds very appealing from the paperwork perspective.
oh my God, yeah. Which is also where I say, on a side note to founders, like if there's any resource that you should be considering putting money in first, it's legal counsel, because there's far too many hoops and hurdles that exist to jump through. But with debt instruments, you have lines of credit that can be offered through banks that can be revolving. You have different types of debt that you can take from individual investors, and they're great. They're much quicker to be able to close from there. But the other issue also with venture debt and other kinds of debt instruments is that you have to provide a personal guarantee or sometimes personal collateral, and that's not always as readily available for companies. Like, it's also very tough when you see people that basically have to put a mortgage on their house, or they have to offer personal assets on as collateral. It's necessary. It's understandable, especially with rates that sometimes are even lower compared to a Clearco loan, or Clearco financing, I should say specifically. But then it comes to the alternative types of financing levels. There's all these different blocks that exist. There's areas like rewards-based crowdfunding, the Kickstarters, the Indiegogos of the world, right? No equity technically is released, but you have a lot of pressure to deliver these products from here. There's equity-based crowdfunding, companies like Republic and Seed Invest that are doing organizations like this. WeFunder is another example. It's crowdfunding from individual investors, but it's also, of course, providing equity or taking equity from you. But it is an opportunity to help raise capital potentially quicker. Then there's revenue-based financing, like ourselves. Now, obviously, I'm a little biased when I talk through it, but what is really pertinent about this conversation on revenue-based financing is that we can actually turn around capital within 48 hours as soon as you plug into our portal. The way that it works is that you plug in we only focus on e-commerce companies right now, I should be specific, but you plug in your payment terminals into our portal, you'll get access to a benchmarking and insights platform that provides over 35,000 companies worth of real-time data and help you basically put together a performance report card on how you're doing in response to your vertical. You also will have everything available to you of our resources, different marketing agencies, inventory shops, 3PL partners, etc., that are readily available and directly able to be connected through our portal. Through that, you'll also be able to receive your financing and then how you're actually paying your vendors and paying other uses of capital through there. The idea is just keep everything holistically within one source. Now, the reason why we keep it like that is because then we can turn around raising capital, conversations, and everything within days versus weeks or months. On top of that, we've backed, again, we put over $3 billion worth of capital and backed over 6,500 founders to date. We still have those 35,000 companies in our network across there as well. But what's been incredible about this is that we've backed everything from small and medium businesses that maybe are just looking for just bank debt. They're not looking to grow and become, multi-million, like multi-tens, $100 million businesses. They're just trying to build great businesses internally. And, having $1 million in revenue is not a failure. It's something that is just so frustrating to me that I hear from it. It's just getting the right capital partner that exists. So we will help back those small and medium businesses. We will help back those companies that are growing much more exponentially and may be ready for institutional capital. We're actually in the stages of building a special deal engine to provide those companies those resources to connect with institutional investors and those investors within our network to find deal flow they've never had access to before. Strong, sustainable, foundational businesses. We're also working on venture-backed and institutional-backed companies, helping them basically cover their working capital. And what I think is exciting about this is the fact that we are able to focus on backing and funding the present, where venture capital firms, private equity capital, all the things that these companies are taking are focused towards the future. So the fact that we can establish and help secure the present makes it basically the companies available to grow and grow towards that future. So, but that's basically how we work. And look, I can always talk about Clearco all day, but the great thing is that we work alongside those institutional investors. We're here to actually be an anchor to the entrepreneurship ecosystem, not to really compete against anyone, but to work with them on it. That's why I joined the company in the first place.
Exactly. And we have a few clients in common. And one of the things I noticed, and I don't know if this is the standard practice, but Clearco would actually distribute the funds to the suppliers or the vendors. Is that correct? Like pay the bills on behalf of
That
the
is
fund?
correct. So
Okay.
basically, once you receive that capital, you will have the ability to pay your vendors directly from there. We also, if our vendors are not in our list, will give you a virtual card that will basically allow you to pay from there. So you don't have to worry about any surprise fees or international rates or anything on that end. We handle those positions. Again, it goes back to the holistic effect of like why we have everything in house, because it just makes it easier for founders. One point to make on that as well, we have a partner matching tool. So let's say you're looking to take capital for marketing purposes, but you still haven't really figured out how to find the right agencies, to qualify them, to go through negotiations. We can help with that. We understand through also the performance metrics card that we pull through for every company, where you may be lacking, and we can help find you the right agency partner that exists from there. Or on the inventory side, same thing with 3PL shops and inventory partners. The bigger thing about though finding that right partner is that, let's say hypothetically you're having trouble with customer acquisition, we can help find someone that's just a great organization, because time is money for founders. So we
Mhm.
can help reduce that time, the pain, the physical, mental, and financial pain that exists from it.
Yes, no, totally. And so we learned from this revenue share model that the biggest advantage is that you don't lose equity. But can you tell us about the advantages and disadvantages of the three types of funding that you discussed before, very high level, just so that our audience can get a sense of what they're getting into?
Yeah, absolutely. I'll go back into them. As I mentioned before, looking at the pros of equity financing, it's you have the ability to get strong, structured companies behind you. You have all the investments on the same page, especially as you're trying to grow. And really, it has a great opportunity to help focus on hyper growth. So if you're looking to really grow the business even further from there, um, and if you really believe it's something that's like can be built for the future. um, the big con though is you are still riding a tight walk or a tightrope between hyper growth and a runaway train per se, because the idea is that when you are taking equity capital or venture capital funding, private equity capital funding, etc., um, the bigger perspective is that you're expecting your growth strategy to actually triple in speed. Instead of basically growing on the typical rate from it, you're having more capital and they're expecting you to grow from those perspectives. Now, the average venture capital return that they're expecting from here is somewhere around 6 to 8 times their return on investment. So that's also something that you have to be aware of if you're considering to take that capital route. It's important. It's great. It also helps you in terms of really to helping to develop a more successful business. But that's also something to recognize from here. That's the pros and cons in terms of equity. When it comes to debt financing, as I mentioned before about the big pros, it's much quicker. It's much more efficient because you have the ability to raise capital. You have the ability to raise capital for much more efficiently. As I mentioned before about that, because again, like the term sheets are much quicker. It's like you have ability to get more successful lines of credit. Um, but as I mentioned about it, the big con is that you do have to provide personal guarantees or collateral, and not all founders will have access to that as well. Now, we don't look for guarantee or collateral through Clearco, and it's more because it's an unsecured level of financing. We're willing to take that risk because we want to provide good, efficient sources of capital, resources, and effective spending resources to founders as well.
Right. And thank you for that, Sumit. And in your own experience, because you also founded your own firm before, you fundraised at some point, were there any lessons that you learned from the process that we can learn from?
Oh man. So
Where to start?
helping helping to grow two venture capital firms, I can just say by personal experience, and this is something that a lot of founders may not initially get, is when you're starting your own venture capital firm, let alone institutional shop or investing or anything, right? It is like building your own startup. Because quite frankly, the economics of launching an investment fund is quite tight, to say the least. Because as I mentioned before, and I guess I'll go into it, is investment funds and firms make their money through two different ways. One is called management fees, and the second is called carried interest. Management fees are basically money that's designed to keep the lights on. So let's say hypothetically, I'm raising a $10 million fund, and it's a 2 and 20 model, meaning it's a 2% management fee and a 20% carried interest model. So I am getting 2% of that $10 million, which is $200,000. That's then broken down quarterly. So 50, 50, 50, 50 to keep the lights on, cover legal costs, cover fund administration costs, cover salaries from here. And usually about 40% of that, around 40 to 50% of that money, let's say $200,000, is already focusing towards those administrative costs. So even for my own sense, I have $100,000 left that I maybe want to pay myself. It'd be tight for me to even consider bringing on another associate or anything, but that's something to recognize. Like similar to most, first-time founders and first-time companies, um, these venture firms will only be paying themselves somewhere between 40 to 60K a year on that end. The carried interest is where the money really gets made, and it's basically a percent of the total profits that go back to limited partners that we take back. So let's say I make a 20% profit for all of our investors. I take 20% of that, which is $4 million. So I'll be able to pocket that with the successful fund. Average funds go around have a life cycle around 10 years. So that's the other perspective in terms of recognizing just the time and effort and growth from there. And my time spending within venture, it's quite, even internally, the rocket ship type of growth that exists internally. But it's also a perspective where we have a fiduciary duty to our investors. So even if we might find sectors and spaces that we're excited about, we also have someone else that we have to spend time and talk through. What has been very interesting about my time transitioning to Clearco is that we're also have been able to back industries and founders and people where venture firms may have run into issues for before. I can go into all those different reasons, but I don't think it's pertinent for here. But I do want to mention this piece. Clearco to date has backed 7 times more LGBTQIA, 9 times more BIPOC, and almost 30 times more female founders than typical venture firms. That alone was a big reason for me to come join and help build that because, again, going back to really building an anchor of the startup ecosystem and building it to a much more global perspective, it's hard not to get excited.
Right. Those are great numbers and very positive numbers. I like to hear those statistics, and it makes sense that you would go for a company or work with a company that has such good, standards. So that I think that's a great sign. Um, when it comes to with Clearco, there must be a way that you guys decide how much to lend the the client, right, in terms of the working capital needs. So, can you compare that model to when a founder is raising equity funding and deciding how much they need? So, how does one differ from the other,
Yeah.
and what should be the approach to determine the amount?
So there's two kind of levels that you have to think through. Let's just stay with venture capital firms for now. The There are, I guess, three things really: the stage that they focus on, whether it's seed, series / Series A, maybe mid stage, Series B, later stage, Series C, Series D plus. Like the lead or participatory ranking, like will they look to lead the investment to set the terms of the term sheet, or will they look to follow on or participate in the round? And then what's their average check size? So those are three things that you need to always ask about with venture capital firms, and it's usually a specific range. Like for example, with SwiftArk, it could range anywhere as little as 100, 150K to as high as a million in the early stage check sizes from there. And it was great, but the problem is that there was a lot of different ranges that you have to exist. So you have to spend a lot of time working through the partner meetings and really determining how much that made sense. With Clearco, it's a lot more algorithmically generated. Now, what I mean by that is we actually, through our portal, once you've connected from there, we will do a revenue forecasting analysis, really looking at where the company's revenues will be going in the next 3 years or so. And we will then provide three different offers, usually range around 1 to 1.2x monthly revenue, where the qualifications for companies to get financing through Clearco is a minimum 6 months minimum of recurring monthly online revenue of 10K a month. Now that's 60K total from that end. So it's quite low in that perspective. But again, assuming the 1 to 1.2x monthly revenue growth, we are usually providing checks between 10K, as little as 10K, to actually as high as 20 million. It's very different.
Yeah, no, that's pretty. I was saying that's a pretty wide range, but it's good to see that they have the options. The founders will have the option to get the smaller loans too, because sometimes lenders or VC firms don't want to provide capital below a certain minimum. So I think that's a great option. And I think you mentioned at the beginning the fees were. I don't want to say the wrong amount, but what were the fees that you guys keep?
Yeah, so the fees, because we focus on inventory and marketing and ad spend, they are between 4 to 6%, depending
Okay.
on the offers that we provide onto there. And yeah, the idea is that like we are building out our offerings in response to revenue and revenue forecasting. So we want to do that so we don't actually overloan or over provide capital to companies where it might be just difficult for them to pay back versus giving too little. So we want to have the right sizes of loans and capital for them.
So, in terms of usage of funding, and you may have touched a little bit on this, but what is there a right way, wrong way of? I mean, there is a wrong way of using funds, of course. What's the best way to optimize capital funds that startup founders get from founding VC
Uh,
funding?
can you
Mhm.
can you actually repeat that question? I want to make sure I heard it correctly.
Yeah. So if let's say we come up with the amount of funds that we think we need for our
Mhm.
company, and an equity funder found, equity finance comes in, and it's a significant, significantly what close to what we expected to need. Now we have all this money in the bank. Is it possible that a founder doesn't use the funds in the best way for the company? What are some of the advice that you can give for founders to use the funds in the best way possible?
Yeah. So I would recommend founders, anyone who's listening to this, um, to think about like your use of funds in 4 quadrants. The first quadrant is product and tech development, really just focusing on the future of your business on the product lines, portfolio, the actual tech platform systems that grow from it. How much of your capital percentage wise you think you need to grow for the next, assuming let's say you're raising a seed round, the next 18 to 20 more, next 12 to 18 months. If it's for larger funds, then maybe for the next 2 years. The second quadrant is focused towards team. Are you looking to hire anywhere specific? Roles wise, you have someone specific looking from this, so on and so forth. The third is working capital. So inventory, marketing spend, ad spend that exists from there. So more infrastructure investment. So what do you need to fortify your current systems from there? And the fourth is what I like to call X factors. It could be relevant to one of those three other areas of the quadrants, but it is something so specific that you need to actually focus on there, whether it's its own time and its own capital from there. You're going to have some companies that are just a lot more structurally significant on the business itself. And so like, great, we need to spend more time putting capital towards marketing. We need to get it more out there. Or we've been doing all this work by ourselves and we really need to hire like a VP of marketing to help me grow from this, or, an ops person from this end. Or we've done well with our first product. We need to develop the next 2 or 3 SKUs on here. That percentage goes higher. So the first level is to really take the time to look at each piece and figure out where you need to effectively spend on that end from there. Um, there are going to be areas that'll sway bigger, but when you start by focusing on those 4 areas, those 4 quadrants onto it, and just draw out without even thinking about a number, drawing out about the percentages of like where you are now, what's next in the next 6 to 12 months, and what's for the future, those next 12 plus months that exist on there. So if you're able to draw that out, you could then work backwards and determine the actual overall pool of capital that you need, and then really being able to selectively put them towards where is necessary.
That sounds like a perfect approach if we can follow it, right? Once the
Yes, of
funds
course.
come in, and then all the bills come from one quadrant and not the other. So I can see how sometimes we don't really follow the path, but I think that's a very good uh, starting point. Sumit, any final advice or any final thoughts that you want to share with the listeners and the audience? And we will share, of course, the link to your company's website, your company, your LinkedIn profile, and all the other platforms that you're on will be included when we repost this video. So everything will be there. But please share some final words that you want to leave us with.
Yeah. One of the areas within entrepreneurship that I've been personally passionate about is the world of mental health within entrepreneurship. It can feel like the loneliest job in the world being a founder because people who love you, the only people who are always going to be with you no matter what are the people who truly love you, right? Your family, your significant other, etc. But it's going to be difficult where sometimes you'll feel like everyone's only there for your successes and no one's going to be there for your failures. It's one of the most frustrating things I have about the ecosystem where areas like the media world and whatnot, like they're much more excited to covering the downsides of things, which it suck, and it's really frustrating when that does happen. Um, I try to spend as much time with founders as much as possible outside of a professional level on a more personal level because it's very simple to get lost in a bit of the shuffle and the hype and the hustle culture that does exist in startups and that ecosystem. But also recognize that you're not in this by yourself. There are communities, there are lots of incredible organizations and communities out there with like-minded individuals who are not just, of course, willing to share advice, guidance, learnings, whatnot, but just be an extra set of ears and eyes from there. So don't ever give up on that end. Be passionate about what you're building through. But also, if you're starting to feel just the light going out from here, feel free to reach out to me on that end. Feel free to reach out to other colleagues in your community, but just recognize that you shouldn't have to go through this alone.
I think that's such a great message because I this is a problem across many industries and even non business owners, right, and founders. So I think it's so important, yes, to remind everyone that you're not alone. There are people that care. Reach out, ask for help, and it just takes one text or phone call, right, to get help
Yeah.
sometimes.
Yeah.
But tell us how, just in case we prefer to hear it, tell us where the listeners can connect with you and reach out.
Yeah, definitely feel free to reach out through LinkedIn. Yeah, you can also follow me on Twitter. It's at PEFeeds, PE_FEEDS. You also could definitely reach out to me through email. It's just, again, sumeet.shah@clear.co. And feel free just to mention, of course, how you connect with me from there. So just making sure I'll be able to get back to you promptly. I do read all my emails, and I'm relatively active on Twitter. I used to be much more active, but trying to get back on there. But yeah, I look forward to having various conversations with everyone here.
Yes, thank you, Sumit. And you heard, Sumit has great experience in the venture capital world, but now through financing from revenue share models, so through a Clearco. So please reach out to him, connect with him, because I think he can be a great resource for your company. Thank you, Sumit, for joining us. We learned so much from you, and we hope to have you back in the near future.
Thank you so much again for your time, and thank you so much, everyone, for listening to me. And here for you again, any way I can be. Thank you.
Thank you.